If you're a homeowner or a realtor, you may have heard about the inverted yield curve. But what does this mean for mortgage interest rates? My name is Kevin Brierton with Neo Home Loans. In this video, I'm going to share with you what an inverted yield curve could mean for mortgage interest rates. To understand the relationship between an inverted yield curve and mortgage interest rates, it's important to first understand what a yield curve is. A yield curve shows how yields on various government bonds change over time. A normal yield curve will show that longer-term bonds, those with longer maturities, offer higher yields or interest rates associated with the bonds than shorter-term bonds, which reflect that investors expect that future growth is going to continue in the economy. Now, when the relationship reverses, this is known as a inverted yield curve. An inverted yield curve occurs when short-term bonds are offering higher yields or higher rates than long-term bonds. Now, this indicates that investors are expecting a slowdown in the economy and in future growth. So when the yield curve inverts, this usually means that mortgage interest rates will decrease as well. This is because long-term mortgage rates are usually tied to long-term bond yields, which actually tend to fall when the yield curve inverts. This makes sense because investors are expecting a lower inflation number and slower economic growth in the future. So they demand lower returns for their investments, such as investing in mortgages, and it becomes more attractive to lenders because they're getting a better return on their investment without taking too much risk, like investing in the stock market, businesses, or let's call it crypto, or other assets. Therefore, when the yield curve inverts, lenders may be more likely to offer lower mortgage rates to borrowers. Now, however, it's important to note that there's no guarantee that the mortgage rates will go down when the yield curve inverts. This just means that there's a good chance they will. Ultimately, whether or not mortgage interest rates go up or down depends on how lenders will choose to respond to the change in the bond yields due to the inverting yield curve. So it's important for consumers and realtors to stay up to date with shifts in the financial market so that they can be informed and make a great decision around their financials and their investments. So thank you so much for watching. My name is Kevin Brierton, branch manager at Neo Home Loans. If there's anything we can do for you, please don't hesitate to contact us. We look forward to helping you and answering your questions.